Hello everyone and welcome to algotrading.pro. Well, after two videos on more advanced trading methods, neural networks, deep nets, and perceptrons, one of our members at algotrading.pro requested that we should continue with our beginners video series and continue talking not only about more advanced methods, but also about simpler things. Simple, maybe, but not less important. And I thought one of the interesting and useful topics for our beginner series is market regime filters. So basically, what are these filters? Well, these filters prevent us from trading when the market conditions are not right for our strategy. As you all know, there is no universal strategy. No strategy will work equally well when we have a trending market versus a mean reversion market. No strategy will work equally well when the markets are very volatile or less volatile, and no strategy will work equally well on all assets, right? So we need some way to tell apart, if you will, these market regimes, these market conditions. And one way to do that is filters, right? So here I kind of classified them for you. Or at least the ones that we will discuss in this beginner series. So today, in this video that is posted on YouTube, I will discuss trend filters, and these can be accomplished by using two technical indicators that I chose here, just for exemplification purposes: the ADX, the average directional index, and the ROC, the rate of change indicator. The other types of filters are volatility filters. The technical indicator that I chose here is the ATR, the average true range. We also have statistical filters, and one of the newer, the more modern technical indicators developed by the creators of Zorro Trader is the market meanness index. And quant stuff, right? Kalman filters, hidden Markov models, neural networks, etc. These three categories will not be discussed in today's YouTube video, but there is already a video in the members area of our website, algotrading.pro, that address these two categories. In the future, we will have a more advanced video about the quant filters. Again, please go to our website and watch the longer video there. The registration is free. No credit card is required, just the username and the password and an email. All right, so without further ado, let's take a look at our very simple trend following trading strategy that we developed before. And just as a reminder, so we are trading daily closing prices. This variable bar period that you've seen before is 1,440 minutes, which is one full trading day. The data structures that you see here are two arrays. In Zorro, the variable type for arrays is vars. And this is the price, the closing price of the stock, and this is a simple moving average. The formation period is 20, and then the trading logic is super simple. This is the hello world of algorithmic trading, right? So if the price crosses above the simple moving average, enter long. If it crosses under, then enter short. And of course, we want to know we want to plot the simple moving average so we can see this. All right, so I'm gonna run this very simple strategy, and what do we see here? Let me remove the equity curve so things become a little more visible. So we see a classical, typical trend following strategy with the major issue that plagues all the trend following strategies that exist to a certain extent. No trend following strategy is free of this problem. So what do we see here? Well, we catch all the trends, uptrends or downtrends, uptrends or downtrends, which catch them all when they exist. But we fail miserably when a trend does not exist in either direction, right? Look at this. This is a trading range here, right? Same here, and so on and so forth, right? So when a trend exists, this very simple method successfully captures some pretty good trades. But when a trend does not exist, when the market is moving sideways, we're still trading because this is algo trading, right? If I were a human, by this time here, by this point here, I would have figured out that, I can't trade the trend following in a sideways market. But this is algorithmic trading. So the machine does not know about this unless we tell the machine, teach the machine about filters, right? About market filters. So is there a way to tell our algorithm, our program that it shouldn't trade when there is no trend? Well, there are several ways, and this is what we call, the market filters in this video. By the way, this problem that again plagues all trend following systems is called among traders the death by 1,000 cuts. The death by 1,000 cuts. So we make decent money on trades when the market is trending, but we get cut 1,000 times and we bleed out all our money when the market is in a trading range, in the sideways market. So death by 1,000 cuts, what a colorful name. Okay, so let's move on and implement our first attempt at this problem. And I'm sure many of you have heard about the average directional index, which is also called the ADX, right? This is a very old technical indicator. It was created by Wells Wilders a long time ago. And it's still in use because under certain conditions it does work. So what exactly is this ADX indicator? Well, it's a directionless indicator. It does not tell us about up or down, but it tries to measure the strength of a trend. And the creator of the indicator believes that if the ADX is greater than 25, then we got a trend. All right. So pretty much what we want to do here is to verify before entering any trades, long or short, to verify if the value of this ADX indicator is above 25. And for that purpose, we will create another series here, and we're going to call it ADX raw. And we'll see in a moment why. And this is going to be a series, of course. And the internal Zorro function ADX, of course, Zorro already knows what ADX is, right? So we're going to use the internal Zorro function ADX. And this only needs a formation period, nothing else. Zorro already knows that it's the price that needs to go in there. So all it needs is a formation period, and that's 14. Okay, now, before doing anything, let's plot this. Please do get into the habit of plotting as much as you can. A picture tells 1,000 words, right? So is worth 1,000 words, they say, and right they are. So so okay, let's plot this ADX in its raw form, and let's give it a new panel. Make it a line and make it light blue. Light blue. Okay, so let's run this. Of course, I forgot to tell the plot function what to plot, and that is ADX raw. Sorry about that. So here it is. So nothing changed in the main panel because we didn't apply anything to the trading logic. So we are still losing all our money at the end because of this death by 1,000 cuts phenomenon, right? So these little red trades, these are killing us, right, pretty much. But here is the ADX. Now, I would like to see the ADX being above 25, right? In order to avoid trading here in this area, right? Now, what I can see on this ADX chart is that it's very jaggy. It's like the price, right? These are unsmoothed curves. The price is not smoothed and the ADX is not smoothed. So they are jaggy. And jaggy like this means that it may take some trades here because in this area, because as you can see, the ADX fluctuates around 25 here. I want to avoid that. So how do I do that? Well, the same way I did with the price, right? So I'm going to take a moving average of the ADX indicator and hope that that's going to help more into avoiding these death by 1,000 cuts, you know, these cuts, if you will, these bad trades. Again, I'm not hoping to improve this strategy much in terms of profitability. There may be other methods to do that. This is indeed a very simple strategy. But what I want to see going away are these small losing trades. I want those gone or reduced as much as possible. Okay, so the first thing we're gonna implement yet another vars variable, another array, and we're gonna call this ADX smooth. And this is going to be, again, the series function of Zorro Trader. And this time is going to be simple moving average. And the arguments will be ADX raw and a formation period of 33. Whatever. Please feel free to play with these values, see what happens. So I'm just making these up as I go along, but guys, I didn't, you know, I have no justification for this number, neither for this or I chose 14 here. This does have a justification. The original creator of the ADX recommends 14 as the formation period and 25 as the threshold. All right, so now we got them both. Let's plot the second one as well. ADX smooth. ADX smooth. And I do not want this one in a new panel. I want it in the same panel like ADX raw. And I'm going to make this blue. Great. So now, before we run this, we have to change the trading logic as well. So what the creator of this indicator recommends is that we shouldn't trade a trend following strategy if ADX is lower than 25. So we will add this condition here. If ADX index is 0, which means ADX of today, remember ADX raw and smooth are time series, okay? So the ADX smooth of today, index 0, is greater than 25, right? So if this condition is true, then curly brace the trading logic here. So entering the long and the short position will only happen if the ADX smooth of today is greater than 25. The other trading logic stays the same, but we wanted to add the curly braces here. So these two commands only happen if the ADX is greater than 25. All right, so let's see what we get. Oh, what do you know? We are profitable now. Not by a lot, it's 6%. But, you know, we turned a money-losing strategy into a profitable strategy by reducing those trading range trades. Remember, we had 1,000 cuts here that were bleeding us dry, right? Those are gone, as you can see, right? So most of the losing trades, the small losing trades we had, are gone. So we only take trades long or short. So this is a good long, good short, good long, and so on and so forth. But we only take trades when the moving average crosses above or below and the ADX is above 25. And the ADX is above 25, right? Okay, so I consider this a small success, right? So this isn't really tradable live, but this is a teaching example here, and I cherry-picked this Microsoft example because Microsoft does have or did have these extended trading ranges, so you could see the effect very, very well. All right, so this is how we can use the ADX. You can try using the raw ADX, the simple one. You can try playing with these values. You should, because when you start playing with these scripts, you kind of realize what the effect of the parameters is, and so on and so forth. So, okay, so this concludes our introduction of the first technical indicator, ADX, as a market filter. So I'll show you another one now, one that I like better, and I think it will give us, based on my past experiences, it's probably going to give us a better result with this simple system. So I will go back to our strategy, our very simple strategy, right? I will remind you what we're trying to accomplish here, which is to get rid of these 1,000 cuts that are bleeding us dry, right? All these trades placed in a sideways market, right? So that's what we want to do. And now we're going to use the rate of change indicator, rate of change, ROC, okay, as our market filter. So what is this rate of change thing? Well, it's in mathematical terms, it's the first derivative to the price curve. Okay, I don't think that, unless you know what that means, what the derivative is. So if you don't understand that, then here is my simple example. It's an indication of how quickly the price changes. So in a trend, the rate of change should be high and go higher. And so in a trend, let's say in an uptrend, right? In an uptrend, the tangent to the price curve, the first derivative, is positive, right? Prices are moving up. In a downtrend, this first derivative, the tangent line to the price curve, should be negative, right? Because that line is sloped downwards. And so it should be negative in a strong downtrend. And in a sideways market, there must be some interval between some negative values and some positive values that should cover sort of trading ranges, sideways markets, right? So this is in principle the rate of change. I encourage you to Google it, and you may find a better explanation than mine. I hope you will. So how do we implement this as a market filter? Well, again, we need to create an array, a vars variable. I'm going to call it ROC, rate of change. And this is going to be a series. And of course, by now you know Zorro has an internal function for anything. So of course it does have the rate of change too. And I'm going to make it the rate of change of the simple moving average instead of the price. Remember, our conversation about smoothness. Okay, so I'm not going to use the price curve. I'm going to use the simple moving average of the price curve. That's going to give us a much smoother rate of change curve. But the principle is the same. So we are going to use the SMA here, and we are going to use a 20 days period, simply because I use that here, so no other reason. So now we have our rate of change, and we're not going to change the trading logic yet, but I would like to see it. I would like to plot it like with the ADX, right? So here is the ROC, rate of change, to help you remember. And this is going to be ROC here. And of course, I'm going to want it into a new panel. And I'm going to make it orange this time. Okay. So I will not plot the ROC raw and, you know, like we did with the ADX, because I'm sure you understand what's going on. So, okay, let's run this. Again, nothing will change in terms of the trading logic and the trades, but I wanted to show you how this smoothed rate of change looks here. Well, it's not a smoothed rate of change in the sense of taking the moving average of the rate of change. Is the other way around. We're taking the first derivative of the simple moving average instead of the price curve. So basically what you see here in orange is the rate of change of the blue curve here. So the derivative to this curve in this point, it's a, you know, a line that touches the blue curve only in that point, and it's sloped downwards because here the market is going down. And the equivalent, the number that describes the slope of that tangent line, is probably here somewhere. Okay, so it's negative because it's going down. All right, so how do I determine when to stay away from a sideways market here? Well, good old friend here shows us, leads the way, right? So we see that the value of the rate of change kind of fluctuates around 5, at least here, right? So it goes a little above 5 and somewhat, you know, some a little more under 0 here, and sometimes it goes as low as -5. But somehow this number 5 here caught my attention. So how do we use that information? And you can verify that this level 5 has some significance through the whole curve, the rate of change curve. So how do we encapsulate this information in our trading logic? Well, we can't do the procedure we did before with a single if here, because now we have two different conditions, right? It's not just one to have a trend. This is the rate of change, and I certainly need an interval here. So what I'm going to do is I'm going to add here a condition that I want the rate of change today, index 0, right, to be greater than 5. I learned the number 5 from that graph, right? And conversely, when I want a short trade, I want the rate of change to be smaller than -5. Okay. So I'm defining a channel pretty much. So when we are with the rate of change inside this channel, 5 -5, we're not trading. So the rate of change has to indicate a strong uptrend in order to enter a long position. Well, a strong or not so strong, but you know, a trend, upwards trend. And for a short trade, I want my rate of change to indicate that the market is moving down. So rate of change positive, market is moving up. Rate of change negative, market is moving down. I'm sure these two values will be different for other underlying assets. This is Microsoft that we're trading here, and I'm sure these two numbers will not work for every stock, or currency pair you can think about, but you know, let's see what we get here. And of course, again, feel free to play with these values. So what are we getting here? Whoa. Now we did it. 234%. And this was a losing strategy. It was bleeding our account dry with those crazy little trades, which are now all gone. So a little understanding of calculus and derivatives can take you a long way. Now, what is this spurious effect that we see here? Why do we have all these trades, multiple trades open at the same time? Is this a bug? Did we just discover the bug in Zorro? No, this is expected behavior. So basically, we do not have separate entry and exit mechanisms, right? So a long trade is opened whenever the price crosses the moving average and the rate of change is positive, bigger than 5, right? So we have opened multiple trades, but we only have one exit mechanism, which is opening a trade in the opposite direction. So pretty much these are 2 losing longs. These are 4 winning longs. So if that's what you want, this is fine. Some people do this. Some people scale into positions, right? Like this. They enter, instead of entering just into one trade here, they prefer to enter into positions into multiple times, and then, you know, they somehow get an entry at an average sort of price, and that can work for you or against you, but that's beyond the scope of this video. The grand idea here is that if you don't want this kind of behavior with this strategy or any other strategy, well, then it's time that I introduce to you beyond the ADX and the rate of change kind of market filters. I will also introduce to you 2 new internal Zorro variables, and these are max long and max short. Well, what do you think they do? Well, unsurprisingly, exactly what the name says. So the maximum number of long trades, okay? How many long trades do you want to have open at the same time? Let's say 1, okay? Maximum short trades, let's say 1 again, right? And you can even do this to save you typing, if you will. You can declare them and initialize them at the same time. So max long, maximum number of long trades, max short, maximum number of short trades, and set them both to be 1. And now when we backtest this, what do we get? Well, as you can see, we're making a little less money, so it wasn't the worst idea in the world to open those trades at the same time. Well, you make the strategy more capital intensive if you do that. So you have more money invested into the market at every single moment. But in this situation, because it's a winner, that is a positive thing. The Sharpe ratio is kind of low. 0.99 is less than I like, but hey, we turned in a loser into a winner. So look at this. We only have 1 bad trade, and I'm sure a stop loss would have minimized the loss there, but we're not doing that right now. This is about market filters. So yeah, so this the ADX has improved. The death by 1,000 cuts phenomenon. The rate of change has completely eliminated. So we are done with the death by 1,000 cuts. And with both filters, we have successfully turned a losing strategy into a winning strategy. Now, if you want to learn more about volatility filters, because I'm sure you know that some strategies work very well in highly volatile markets, while others do terribly in high volatility, and vice versa. Statistical filters, you know, the market meanness index. This is something original to Zorro Trader. And more cool stuff, right? Just go to algotrading.pro, register for free, and you will see a video that's already there about these subjects. Here on YouTube, please give us a like, share this video with your friends, and until the next time, happy trading.